Hey guys and girls, it's Birchie here. It's Tuesday night and I am live. Just realizing that it's now daylight saving, so a few of our viewers over in Western Australia or Queensland or Northern Territory, whoever's watching us out there, maybe like, why is Birchie on at 6 o'clock? Why is he on at 3 o'clock? Wherever you're watching this from. So yeah, it is daylight saving has ended, has started, which is great. Really like the sun being up for longer and all that. But yeah, here we are live on Tuesday night. So thanks for everyone that's joining in, and got some exciting topics for us to discuss today, some news articles, and my discussion around for today will be around sort of building a portfolio, how to generate cash flow from that, when you should be expecting to get cash flow coming into your account, and all that sort of stuff. So stay tuned for that. I'll get into my instant stuff, which is the elephant in the room, talking about the interest rates, talking about the RBA, what has happened today with the RBA, where are we heading with it, and what is my thoughts and views and prognostication looking into the future. So I've made quite a lot of comments over the last decade around interest rates and the cash rate out there in general, predicting where interest rates will go. I did get things a little bit wrong, and when I say a little bit wrong, it isn't because I was wrong, it was because I just may have been a week too early, a month too early, whatever the case may be. So what have we got here? I'd love to know what your prediction of the rates are when they reach their next low. These times are exciting. Government debt now at over 33.15 trillion. Exactly, Sam. Exactly. So let's look at the elephant in the room. The RBA met today and they said the rates is on hold, right? The interest rates aren't going up. Ooh, everyone should be celebrating, right? No one's talking about the fact that they've increased the interest rates by 4% in the last 18 months. And it screwed everyone, right? And we're not talking about just you guys being the investor or the mortgage holder or whatever. I'm talking about the whole economy. What has happened with them pushing up the interest rates this high, and what does it mean moving forward, and where do we go? I always said, this is where people think that I was wrong, I always said that we can't be high, they couldn't move interest rates more than 0.5%, right? Didn't say they wouldn't, I said that they couldn't, right? And if you go back through my older videos and my old lives, I actually mentioned that if the interest rates went up higher than 0.5%, that we would start seeing the system fall apart, which that we are, right? That we are. The longer that they keep the rates at this level, the bigger the crash is going to be. The higher that they push the interest rates, the bigger the stimulus packages have to be. And I've got some really cool news articles to talk about around that today, and I'll tie it all together. So just for those who would have been forced to reduce interest rates by the end of financial year, and surprise, surprise, we haven't seen a rate hike since the end of financial year. When are they going to come backwards? Who knows, right? I always said that we wouldn't see it before the end of this year. We wouldn't see, I didn't care what had happened to the interest rates because we'd see them reverse course of monetary policy. And I think we're right on the eve of something big happening out there. And I'll go into that in a moment. But we go here to read this article. It's the fifth time since the RBA has paused its current rate hiking cycle since May 2022, when it began lifting rates to reduce high inflation, and leaves the cash rate at its highest level since April 2012. Tuesday's board meeting was the first under the new governor, Michelle Bullock, who succeeded Philip Lowy last month. The RBA's decision, I'll leave this lady a month or so before we start butchering her name and giving her some grief and giving her some shit anyway. But it doesn't matter who sits at the chair, right? We know who owns the chair, who's playing with the strings behind that chair, and whose puppet they really are. So it goes on to say the RBA's decision leaves rates unchanged in line with financial markets and economists had expected, despite inflation rising slightly to 5.2% in August, up from 4.9% in July. So if we really look at that, 5.2%, So 520 basis points over 490 basis points is about a 5% increase in inflation, right? So if we look at the value of our dollar, like the purchasing loss of that, that has ramped up another 5% on the losses just in a month, right? And I want you to really think about that, right? Because if you had 5% for a month and compounded that, that would be 60% in a year. That means inflation would run up 60% in a year at that rate, right? But no, they're not increasing interest rates, right? And they said that they're increasing interest rates to control inflation, but they can't. This thing, the genie is out of the bag, and there's no way of popping it back in there without killing our currency. And they will kill our currency. It's just a matter of when and how, and what sort of collateral damage is caused along the way. It goes on to say it's the first time monthly inflation had increased since April due to a surge in fuel prices contributing to higher transport costs, along with rise in housing, food and insurance prices. So if we think about it, your food's gone up a lot, right? I said to you guys a year ago, those petrol prices, the fuel prices, the commodity prices, right? Who's been buying commodities, right? Woohoo! Who's been talking big about commodities? Because these things go up with inflation. So we're now seeing that being passed on down the food chain, right? So fuel cost goes up by 20%, your food goes up, your housing goes up. And it's funny because they've really pulled housing apart, right? In the CPI, when they do, consumer price index, when they tell you these inflation figures, going back in 1970, you could have bought a steak and a house and a suit and, all that. And that's what they were basing inflation upon. But then it started, it went from you being able to buy a steak to you being able to buy a sausage to you being able to buy Beyond Meat or a fake meat product, and that's what they're classing meat as now. It went from owning a property to a mortgage on the property, an average mortgage across a property, down to the rent of the property, right? But when we look at inflation, they've pushed up the interest rates for everybody, so rents are going skyrocketing, right? They're running away with inflation. So I've now just reassessed, right? This morning I went through all my owners for their December rent increases throughout all the properties that I manage throughout my property management businesses. And I pushed up a whole pile of rent. Some were $150 a week, some were $180 a week, $200 a week, in increases in those rents. And this is nationwide, right? I'm not discriminating against one pocket or one state throughout the country. So as I go through and manage my investors' portfolios, I'm like, these rents, right? I can tell you that it's not just, rent going up by 15%. They're saying rents have gone up by like 20% or 18% across the board, right? But that 18 or 20% gets slotted into CPI because that's where they're basing the benchmark thereof. So the expense bill is going up. It's just going to naturally keep increasing. And then they'll just keep manipulating and say, well, we weren't talking about rent. We were talking about average rents across a 10-year period. And they'll manipulate the shit out of it again. But what I'm physically seeing out there is that if you've got a $300 per week and it's gone up to $450 a week, that's like a 65% increase in your rent in a year, right? And that's amazing, right? It's amazing for you guys that are renters, for landlords. It's amazing for some people that are renters too, because there's opportunities of things that you can do, around that. But it's just interesting. So you need to look at the finer details on what they're saying. So they're talking about inflation has gone up, but they're not going to touch the interest rates today, right? But what I have also noticed is that the global economy is crashing and crumbling and falling apart out there. So the more that these things are occurring, the less movement they've got. So we're now faced with a position where the central banks are seizing up. They have no power, right? Wow, they put the interest rates up for 4% over a year, right? It went from 0 to 4%, big whoop, right? 4%, who cares? But the implication of it going to 4% is just starting to be felt, right? It's causing a massive depression. It's causing massive liquidity issues out there where there's no liquidity floating throughout the markets, meaning that they have to do something to re-stimulate those markets, which is putting in universal basic income, putting in stimulus packages, putting in tax benefits, all these different types of things. But without those institutions going broke in the meanwhile, right? So if we go and look what's happening, the ATO, they've put on more staff, they're trying to be harsher with collections, all those sorts of things, because they're broke as well. And we look at the levels of debt, and that takes me into my articles from today. And I might sound like, this is something as well, I might sound like I'm a depressing, whingy, doomsayer out there, right? Everyone else is going, oh, property prices are going up, right? I'm not, right? I'm sharing with you guys, which everyone else fails to do, is looking at why do our properties go up in value? Why do they do certain things? And we're in a position where inflation is just going to ravage everybody's household, and it's going to be very bad for a lot of people. For some people, it'll be very good. For me, I get scared from it because I think about, shit, I'm actually right, and I know that my moves have set me up for amazing things. But 99% of people aren't going to be like that, and that's unfortunate state of affairs. And even for myself, I think, okay, what about other moving parts that we all have, our inputs into the matrix where our fixed costs could rise as well. So I just want to make sure that, my incomes are far exceeding those fixed costs that I have, which are rising with inflation as well. So just trying to, my point is, I'm just trying to share with you guys to be excited, to plan, to have a strategy, and to take advantage of the opportunity, because it won't always be out there. Here's a chart which I think is important. I'm just going to increase my screen here just because I don't want to share my whole screen with everybody. But here we are looking at a chart, and this is interest rates over the course of here's interest rates over the course of the last 33 years, being since 1990. And we can see where it goes down and up and then down and up and down and up, and it goes sideways. And the thing is that every time we have some sort of catastrophe out there, we see rates drop. So most people would be fearful of a catastrophe, where I'm actually very excited because I'm like, hang on, that's the opportunity there for me to take advantage of the catastrophe, and I'll do very well from that. So a lot of people are thinking, today, 6 months, 12 months, without looking at 2 years, 3 years, 5 years, because a lot of things from 3 years ago people have really forgotten about and are back to their normal life and just being blindsided by the fact that they're being, indoctrinated, slaved, and robbed. But anyway, we won't get into that. So this is a news article here from news.com. I will share these articles in the Birch feed later. I don't have a printer here. I'm at my holiday house, hence the wall here. And this room that I'm in doesn't have an aircon, so it's a little bit hot. So if I'm looking like I'm sweating, it's not because I'm a central banker. It is because it's a bit hot in here. So this one here, I'll post all these articles in the Birch feed just soon after we finish here. If you're not on Birch feed, go to birchfeed.com, birchfeed.com. Register, subscribe. I send some random things out there sometimes. Sometimes like, why is Birchie talking about chemtrails in the sky? Why is Birchie talking about weather manipulation? Because if you put the dots together, you'll see that the lie is not just linear, it's lying from all different aspects of our world. So I do put some weird stuff out there, but I do put a lot of economic stuff there, and a lot of stuff that I read, see, watch, and hear where I agree with sort of 80% of it. I'd share it with you guys and tell you my thoughts on it. So it's a really good tool to be involved with. A lot of people that are there really, really like it. So join up today. It's free. No need to be a tight ass. This article that I'm going to read now is China caught in its own debt trap over Belt and Roads Initiative, right? That was the thing that we talked about quite a long while ago, right? We talked about the fact that these countries, right, everyone's scared about their interest rates. Oh, my interest rate's gone up from 3%, it's gone up to 6%, right? Yeah, that sucks, right? But that's short term, right? If you have a strategy where you've got properties where they're low priced, with low entry barrier of entry, if you've got a 200 grand property, when interest rates go up by 3%, it's not really that much that it goes up by, but the ability of your rent going from 300 to 400 a week puts extra cash flow through from you. If you set yourself up, a lot of people over the last 10 years are like, oh, that's too boring, Birchie, I'm going to go buy blocks of units, I'm going to subdivide, I'm going to develop, all these sorts of things. But they're not thinking of the bad things that could happen out there. So having a good, solid strategy. So for myself, and like obviously my interest rates have gone up a lot, but for my investors, their interest rates have gone up, but their rents have gone up in line with that as well, significantly. May not be as much as the interest rates, but you're not in big trouble. It's not like you've got $1 million mortgage and you're paying that mortgage yourself at a 3% interest rate and it's suddenly gone to a 7% interest rate. That's where people get hurt. So when we look at it and we look at us, mere normal people out there, compared to the corporations that control us, to the central banks, to the governments that control us, and all these sorts of things, you'd sit there and think, okay, well, these guys are in control of things here. But no, they're based on debt, right? And as Sam said in the comment beforehand, that the debt bill is now up to 33.15 trillion in the US alone, right? And that's just surface level M1 money supply that they've printed the money and sent it out there into the system. That's not talking about other financial instruments, derivatives and whatnot that are created beside that on off-balance sheet transactions that are occurring. But if we just look at that, I think it was an article I was reading the other day before Trump took in, and he goes, oh, it's $20 trillion worth of debt, I'm the greatest out there and I'm going to change this and I'm going to change that and whatnot, right? But you look at Trump, and then when he left office, he had like $25 trillion worth of debt. So he added 20% to that bill over a 4-year period. And then we look at it now, and it's gone up from 25 trillion all the way up to 33 trillion. And it was only a few months ago that it was at 31 trillion. So it's gone up 10% in a period of 6 months. And as this debt rolls off, these are not 30-year mortgages that people have, folks, that these governments have. These are bonds. These are products that are 2-year, 3-year, 5-year, 10-year treasury bonds, which, just put it aside, right? No financial advice given in case there's any sort of regulators watching this wanting to try and pick on my choice of words. But when you look at your super fund, right? What is your super fund invested into? Is it invested into physical assets, or is it invested into bonds and stocks and other types of Ponzi scheme financial instruments that are out there? So when we look at that and we think, okay, the governments around the world are in tens of trillions of dollars worth of debt, right? What happens when they have to renew that debt and they don't have the interest to pay, so they have to take on a high level of debt? It means that the debt that they have keeps going up at an astronomical level, and it becomes a hockey stick sort of curvature that is going up. So we're looking at places like China at the moment, and these are very large economies, but they're also built on debt. And where do they get their funding from? It is by selling off bonds to wherever they want to sell them off to pump the economy up. So here we are. China is caught in its own debt trap, which is very fitting because all governments around the world are caught in debt traps at the moment, right? So it's not just mums and dads that are going to go broke in this. This is the fabric of the financial system which will go broke if they don't fix this around. And what will they do when they fix it? And how far will they have to go? And what sort of things do they need to do in order to fix that, right? And we saw it happen in 2020. And every time there's a crisis, they keep making these stimulus packages. It was Kevin Rudd back in 2009 where he gave away $900 to everyone, put some solar, some insulation into your pink bats into your roof and stuff like that. Now we're in 2020 and they, giving away free checks to everyone, $5,000 here, 50 grand there, 20 grand here, put your mortgage on a holiday, whatever the case may be. Here we are in 2023, they're trying to take that back, but the system won't allow it. It actually needs a lot more. So it's like flying down the road, and instead of doing 60 k's an hour, we've been flying down the road at 150 k's an hour. When you slam those brakes on, we ain't going to just slow and pull over to the gutter. We're going to fucking fly around like Mario Kart slipping on a banana. And that's the financial markets. And it's at that point that they're going to come back in and fill that system back up and try and fix the mess that's been occurred. So this here says, has Beijing snared itself in a debt trap? The lure of cheap cash has bought it diplomatic support and access to ports across Africa, Asia and the Pacific. But now those nations are struggling to meet repayments and someone still has to pay. China is the loan shark with no legs left to break, right? When you think about it, right, they are the sharks out there, right? There's these institutions, organizations, financial groups or parties that not parties. I'm not talking about government here. I'm talking about things that are bigger than government anyway. Yeah, it says here, the problem is that a lot of countries that China is loaning money to are broke. Sri Lanka has offered a major port and 100,000 endangered monkeys to keep Chinese kneecappers at bay. It's funny, right? This is not fucking joking here either, right? I'm laughing because it's so bad. Sri Lanka has offered a major port and 100,000 endangered monkeys to keep Chinese kneecappers at bay. Beijing needs to give the VIG repayments, and the countries it bet on can't come up with the goods. So what do? Right? They have the ability to repossess. They have the ability to start demanding for better terms and conditions. Okay, you can't pay for it this month and this year and this next 2 years, but what can you bequeath to us, as an alternative? These are where these agreements start getting a bit funnier, right? And they start, these aren't what you sign up to. No one signed up in this country for the level of debt we've got. No one signed up in the rest of the world the level of debt. The policymakers, the controllers, the rulers, the power brokers have been able to put this into place. Also says here, China is struggling under the weight of its own internal debts, largely unregulated loans under its shadow banking network of trusts had propped up a property building bubble far beyond the point where it should have burst. Now it has a multi-billion-dollar speculative developers are on the brink of collapse. But their creditors want their money back. Contractors can't survive without cash, and suppliers need to be paid for their goods. So we've got a credit squeeze here, right? We've got a credit crunch, which is no different than what happened in the GFC back in 2008. However, it's on a much larger scale. And, people sit there and go, oh, well, isn't it going to be for bad times, right? It will be for some people, but the opportunities that are out there are so fantastic. Should you be waiting to go buy assets? I don't believe so, but there's still very, very undervalued assets due to inflation doing its thing, which makes properties, 20 cents in the dollar that you can buy them for what their actual intrinsic value is worth out there. Just because a property was built 5 years ago and inflation has taken it away, for you to replace any of these assets out, if you're buying the right assets, those properties are worth far greater to rebuild or to pull them apart and use them as scrap than what they would be to actually construct and build these things, which, as I said beforehand, they're trying to find other elements of what they can negotiate on and different things that they can come up with. Sri Lanka is saying they'll give a port away as an interest repayment and 100,000 endangered monkeys to keep the sharks away. What other things will they be doing in order to prop that up? We'll be taking on more migrants, right? Here as Australia, we're bringing in 600,000 migrants this year, and nearly a million migrants will be coming in over this year and next year. So what does that mean? It means that we've got more people paying taxes and we've got more slaves entrapped in the system, meaning that we'll be able to service our debts a little bit better. And they'll just keep fudging these books as much as they can to keep this beast alive. So is it all bad? I think that the only one bad thing that's going to come is inflation, right? It's going to screw everybody. But if you've set yourself up, you're going to ride the wave of inflation and do very, very well out of it. So I just realized I had a drop out of the internet here. This is not something that we have seen beforehand. It's very different to, here we are in a market where we've got rising interest rates, rising inflation, but interest rates have gone up 4,000%, sorry. There's 40 times interest rates have gone up from where they were. They were 10 basis points, now they're 410 basis points, right? There's a lot that they've gone up. They've gone up 400 points. 400 over 10 is 4,000% that they've gone up in the last 18 months. But in the same sentence, right, we're now seeing properties at all-time highs. We're seeing booms happening out there. And it's because people are having a distrust to the currency because the currency is losing all of its value. And that's the opportunity. But here we are. Let's look a bit more of it. As the world's largest bilateral lender, China faces challenges in dealing with the debt distress of some of its borrowers, says University of Tokyo professor Toshiro Nijiwara. Whether China can support those debtors and avoid trapping itself in unpaid debts will depend on its policy choices. I think it says it all in the article. Let's go and look at this next article. This one here is from Accountants Daily. Revenue to slump 12% and gloomy outlook for retailers, right? So we've pushed up interest rates. Why are interest rates not going up? So because we're about to see that part where the system breaks and fall apart, right? And when it does break and fall apart, it will be very quick. It was very quick in 2020. The stock market lost 40% of its value in a period of a month. And then they put in the money printers and then it took back off and everyone's like, yeah, we've hit all new time highs, but they didn't realize inflation had made the 100 grand in start of 2020 doesn't buy you what 100 grand does in 2023 because it bought a hell of a lot more because inflation has, just papered over and hit in a mess. It's kind of like what they've done is, you go to a house and you see some YouTube videos. I don't know if anyone's ever seen this, but you see like a hole in the wall and then you just put a piece of sticky tape on the hole and then you paint over the sticky tape and then the hole is hidden, but you can still see that there's a line around the outside. And all it takes is someone to peel that off or for that to frail and fall off. And then you've got a hole in the wall again, but it looks a very hideous hole because it's all been painted around it. And that's where we're starting to see at the moment is that there's holes in this system and it's starting to fall apart. So it says here, retailers are on track for a 12% drop in revenue this year compared to 2023 as monthly turnover slumps due to the wavering consumer confidence, according to payments company Ewolix, whatever the company that is. Managing Director Luke Latham has said it has been a slow year for many retailers, judging by its forecast, which was calculated by using a representative sample of its customers. 1 in 2 shoppers are saying that they are relatively recently purchased a different brand to what they usually would due to price. The elevated cost of living means that the price will stay firmly front of mind for customers. He said that retailers should examine their cost and find other ways to bolster profits. Businesses need to take stock of all their costs right now across the board. It's not just the big ticket items that eat into profits. There's dozens, if not hundreds, of unnecessarily everyday costs that are chipping away at the bottom line. He said the predicted fall in revenue comes as the latest ABS statistics show that retail turnover grew just by 2.2% in August, below the economist expectations, down from 5% in July. Anyway, we can read the whole article, or we could sit there and realize, well, shit, maybe retailers are down 12%, right? And in a world where we've got inflation and all these, it's all coming to a convergence. And when something breaks, that's when we're going to start seeing the fun part out. And when it does break, it's not going to be bad. It's going to be bad for people that don't know what's happening or don't have any understanding. You're going to go, oh, what just happened there? Oh, the whole world caved in, right? Or they're going to be like, oh, great, that's the right timing, because now what we're going to see is a change in direction of 1, 2, 3. And I'll be sharing that with you when I see it, but we're just in limbo land at the moment. It's just a matter of timing for it to happen. Here's my next article from news.com. Australian rental crisis is getting worse, not better. Congratulations to all those homeowners out there that are investors. 2 factors conspiring to create a hotbed of crisis that shows no signs of abating. Will Australia follow Canada's radical solution? Since the rental crisis began in the nation's capital cities back in 2021, it is the thorn in the side of millions of Australians. Vacancy rates have dropped to historic lows and rents have been set off for the moon. Earlier in the year, there were some potential signs that the crisis may draw to a close in a not so distant future as rental vacancy rates begin to rise in most capital cities across the nation. In short, order rental price growth began to moderate, raising hopes that in time the resurgence in share housing and more Australians returning home to live with mum and dad would return the market to a degree of balance. It's not because of anything. Well, there's 2 parts. One is now that we've got migrants coming through, which is going to put a big supply and demand imbalance in the system, because we can't print enough properties for the new demand to meet that. And if we do, it's at a much higher price, meaning the price is going to get shifted even further. But at the same time, there's people out there because of the cheap credit that was available, that people have vacant holiday homes and stuff. I've got 2 holiday houses here. I'm not saying it to be a dick, but it's like, they're not bad to keep vacant, right? They're properties that are, there are 2 properties that could have been a rental. I know there's going to be someone with no fringe, pink hair, blue hair, sitting behind a keyboard going, this prick, how dare he say that, they should give this to whatever, right? No, it's just a system that's out there. And, a lot of people have taken properties out of the market. There's one thing that's out there. But the second thing is why did it happen in 2021? That's when inflation kicked in. That's when, people were selling a car that was a Datsun 1600 going for $3,000 is now selling for $40,000 or whatever. Don't quote me on prices because I'm not that attached to car values, but we're seeing everything blow up in value because people had access to a lot of cheap, easy credit that's out there in the system, and that's why everything started rising. When you start throwing on higher interest rates, it means that people can't afford to buy those properties. It means that more people are being pushed into the rental market. When you're pushing up the price of the mortgages via inflation, via monetary policy, it means that there's there's more people needing to be able to rent because it becomes cheaper, so it pushes the cost up of tenancy in those properties. So it says here, after the slight easing in variances over the first half of 2023, this is a somewhat disappointing result for tenants. Clearly, the acute rental shortages remain with us, and besides more people grouping together to share the burden, there is no significant solution on the horizon. Everyone is getting angry. The dirty landlord, the dirty investor, right? Well, if the dirty investor and dirty landlord didn't pay stupid interest rates, didn't put their balls on the line to buy that property for you, for you to be able to rent it, you wouldn't have a rental property. It would mean that there would be a worse situation that would be out there. And no one is pointing their finger at the real cause of the battle, which is because they just printed so much money. So it just is what it is. It says here the vacancy rates have all plummeted. They're continuously going down. So, for example, Sydney vacancy rate is currently 1.26%. It's gone down 0.19%. So let's just call them basic points, right? So 1% is like 100 points, let's call it, right? So it was 126 points is at the moment. It's down 19 points. So it's like a 10% drop in the month. The quarterly drop is 23 points. The annual drop is 36 points. Since March 2020, it's down 60%, right? So they're big drops in the availability of properties that are out there. Interesting time. Why is it doing it? The more policies that they put in for everybody, the more that they try and tighten and control rental markets, the more damage that they're causing, right? Tenants are going to say, well, I'm going to stay here longer, right? So if the tenant doesn't move out, then there's less liquidity in the market when it comes to rental properties, right? There's less liquidity in the market when it comes to rental properties, means that if someone's not moving out, there's less coming up for vacancy on the screen. It just exacerbates the dilemma that's really out there in front of us. So it's says here Australian number of temporary visa holder categories likely to require housing is up to 2.2 million people. In January 2022, it was 1.6 million people. So that's 600,000 people difference in the 12-month period that require permanent housing here in the country as well. So you're adding these things together and you start to see a big picture here. So this is the same article, the rental crisis is getting worse, not better, from news.com. It says here the numbers. While Australia, New Zealand, Canada and Britain share in common is that they are seeing or have seen record levels of net overseas migration. Why do we keep bringing migrants in? Because we need to prop out our dodgy financial system that's out there, so we need to keep bringing new players in so we can create extra liquidity into our system. So that's why we're seeing migration at the levels it is. But when you really look at these numbers, it's amazing that every country is doing the same approach by just bringing migration in, which they can't just print enough money. They'll just print more visas where people can come in and then use that for leveraging those people. Anyway, go on to our next article, which is, it's funny because something happened. I said it years ago, and this is really sad. I'm going to have like animal lovers that will hate me and all that sort of stuff. In Zimbabwe, in the hyperinflation when it occurred, and Venezuela, I think it was Venezuela, they were breaking into the zoo, cooking the endangered animals and using them as food because they couldn't afford food. Now, here's an article, mainstream media. No one's even caring about it. The things I said years ago about these topics were, kind of eccentric, wild, conspiratory, and out there. But now it's just mainstream media. Wildlife Conservation Group pleads public to donate to food to Chinese zoo as animals. The public to step in as China's mounting debt crisis spirals the nation out of control. Chinese Wildlife Conservation Group has a desperate appeal for volunteers to donate food to animals at a zoo due to lack of funds for feeding the animals, pointing to a much bigger crisis. The ugly debacle has raised concerns for animals held at other zoos around the nation as inflation takes hold. Right? This is being written in history. Go and research what happens in hyperinflation, because we are heading for a hyperinflation. We will lose our currency this decade. The minute that they change monetary policy, just be very comfortable with the fact your interest rates have gone up and that they are high. Because for 99% of people, 98% of people that aren't planning, preparing, or ready for this, when hyperinflation kicks in, things are going to get really wild out there, hey? Like, you won't be able to afford food, you won't find food, you won't have access to basic amenities that we have, and the world that we are in won't appear as it is today. Right? I'm not trying to be doom and gloomy. I've seen it. I've done a lot of research into hyperinflations, and the writing is on the wall. They literally, here we are in China, the biggest economy in the world. The leaders, when it comes to taking over the world, right? But they can't feed the animals in the zoo due to inflation, right? This is showing severe cracks in the financial systems out there. It says here that has not received state funds for 6 months and was facing financial difficulties. So as of, I think, this week, the US is not paying any government staff because of not at a point where they can roll over their debt. They haven't come to an agreement, so they're going to shut down all government bodies. So be it Parks and Wildlife, be it, all these, Postal Service, the US Post, all that sort of stuff will not be operating. They will not be getting paid. They'll be doing it voluntary until they reach an agreement where they've got money, because the US doesn't have any money. And here we are, where there's been no funds given to this zoo in China for 6 months. So here, the financial crisis is the result of the pandemic and a real estate slump that affected local governments, causing them to drastically cut spending. The Endangered Species Fund raised the alarm via Weibo post this week, pleading with the public to help feed starving animals at the tourist hotspot. There are bear cubs in the park that need to be fed. It's about to give birth, and her food has been reduced by half. The zoo staff have not been paid for 6 months. So the zoo staff in China haven't been paid for 6 months either. So just interesting, right? This has happened throughout history. This is not new. You might be new to everyone that's going to be seeing this stuff occur, but it's occurred many other times. You want to know what happens, and the people that really take advantage and get ahead in hyperinflation. So there we go. Keep the questions coming through. Here's another one. I've already read this one. This is an old one, so I'm going to not read that. This is an interesting one, and the Victorian and Melbourne people might be excited because Dan Andrews has gone last week. But, it just goes to show, you take the puppet away, right? The hand is still there, right? And the people are still going to be as crazy, as ludicrous as what they have been doing up until now. You just don't change the face, right? You're just changing the puppet on the end of the handle. So goes on to say, short stay industry slams Victorian holiday rental tax. Victorian Premier this morning did something no other state leader has done by dropping a bombshell policy that has been labelled half-baked. This is all to the Airbnbers, right? Let's buy a property for Airbnb, right? These things are untested, untried, haven't been happening for many, many times over. So there's now a new tax. Here it goes on to say, on Wednesday morning, Victoria went out on its own, becoming the first Australian state to tax short-term renters. They'll be slugged at 7.5% levy that has been slammed by short-stay rental groups. Mr. Andrews announced a much foreshadowed short-term accommodation levy, which is mourning as a part of his housing market thing. Under the plan, the levy will be set at 7.5% of the short-stay accommodation platform's revenue. The government announcement has said it will be on the 1st of January 2025. So you'd love to be in the motel game, picking up things on the cheap, and being in a position where when they stop the traffic going to these other providers, it means that a lot of people are going to be going back to motel accommodation, and yours truly could benefit from that. So I just found a bit of a giggle in there, because I think that once one state tries to roll out these things, it will be rolling out via other states, territories, governments around the world. So just something interesting out there. If you're running your property as an Airbnb, it could be unsustainable sort of strategy. And you will not see one video where I talk about short-term rentals. I try to stick away from it, because it's not something that I see value in. It's not something that I see as a sustainable model, because your wealth is to be built over the next 20, 30, 40, 50 years, and to carry you through for intergenerational wealth. And I don't see by making a few dollars from a short-term stay, if you weren't doing a short-term stay, you could be in a very caught-out position, just like people were, going. So I'm just seeing comments coming through. So yeah, with it, if you're buying a property for an Airbnb, basing on Airbnb revenue over the long term, and you weren't to be running it, you weren't renting it just as a normal rental accommodation, would that be positive or negative? This happened in mining town booms, when people buying at the top, going back 10, 15 years ago. So just a few bits of news articles today. And now we're going to get into tonight's real crux of our discussion, which is the different stages of a property investment strategy. When should you be getting positive cash flow through? How can you use a property investment strategy that's going to be tried and tested throughout different times to be able to support your lifestyle, support in the long term? So it is so hot in here. As I said, guys, I've got no aircon in my holiday house. I'm in the one next door, and I film these things from here, and I forgot to open up the windows, but there's no aircon in here. So looking at, I see there's a few little comments there. Interesting times, right? What will happen to our interest rates? Right? A lot of you guys might be like, okay, you've just given us a lot of negativity there, Nathan. Like, surely there's got to be some silver lining in here. We're at a point where if you have a large level of inflation, if you have a hyperinflation, the only way to get rid of this debt is to make the cost of debt worthless. So I foresee, and without giving you guys financial advice, no one hold me to this, because I am just a crazy guy on the internet, just sharing my thoughts and views on the world from a alternative sort of viewpoint, which is generally right based on all the data that I sift through. Looking at where things will go, we're at a point where just a sitting game until we see something really collapse out there. Once it does, and I think we're on the eve of it, right? Whether it's today, tomorrow, next week, next month, the month after, even next quarter, how far can we go through this? We're heading towards the end of the year, right? There's still enough time. A lot of times when we've seen recessions and depressions occur, they've generally started in the final quarter of the year. So September, October, November period. So exciting times to be alive. So when that does occur, we will see a reverse in monetary policy. We'll see them turn the printers on. We'll see interest rates drop. If you go back and look at those charts I've got shown beforehand, how far did interest rates drop? They fall like 5 times faster than what they go up at a much more significant level. So I do see us at a point where we would be going negative interest rates. People said, Birchie, you told me this years ago. Well, we did get down to 0%, and we've been stuck at 0% interest rate policy for a very long time. But next time it's going to be a totally different story, because there's no more levers for them to pull, and they're going to be out of bullshit stories to be sharing with you guys on the media about, oh, this is because of this, or this is because of that. They'll find one. They'll find another thing to blame it on. But the reality is that there's only one way to fix this problem. That's by killing the currency. So that's the exciting thing, and the exciting opportunity for the course of this decade. So I want to get into, as I said, the crux of today's sort of discussion, which was, as the heading says here, how soon can you get your money coming in from your property investing? I see people trying all different things. They just want to get they're chasing the dollar. Most people are chasing the dollar. This actually reminds me of something. The most successful portfolios that I've seen out there is with people having a solid strategy, but they're looking to accumulate wealth. They're looking to accumulate assets, because if you know how this game is positioned, you want to be accumulating assets. Doesn't matter about debt. The assets are what's important, because the debt becomes irrelevant with inflation. You can pay that debt off much easier with inflation, but the assets are getting sucked away with inflation. So a lot of people will be sitting there and they'll do silly things, right? They'll forget risk, like we're just talking about with the short-term accommodations and Airbnbs and all that sort of stuff. I'm sure there's lots of people making money out there, but how sustainable is that in the 5, 20, 30, 40 year sort of timeline of your investing journey? Are you doing it just to make a quick buck, or are you doing it to be able to build sustainable wealth for yourself and your family to take you through retirement? So you want to be looking at, where are you? I think everyone should be having a plan out there. I always talk about this. You should have a plan and a strategy to go, okay, where am I at today? What options do I have? Do I have capital? Do I have cash flow? What do I have going for me? What don't I have going for me? What does the bank require from me to be able to help me build my portfolio? So I would be looking at, what stage of your journey you're at, where you were heading, and sort of reverse engineer as to what you need to do today in order to get to where you want to be. I see a lot of people, when they come to me to talk about, hey, Birchie, give me some advice, let's get some properties, let's buy some properties and all that. For those of you that are watching that may not know about B.Invested, I was one of the first buyers agents in the country. A lot of people call me the OG of property investing and buyers agency space, because nowadays there's buyers agents galore out there. When I first started, there was no other buyers. Maybe there was like 3, 4, 5 buyers agents out there going back 15 years ago. Sorry, I just had a little mind blank. Most people come to me and they've said over the years, like, not so much nowadays because you guys are educated, but a lot of people have come to me over the years and have said, that's why I don't go and sort of scout for, business and put ads in all the property spaces, because everyone's out there got an idea like, I want to buy a house on land that's going to appreciate because the land goes up in value and the building depreciates. Well, if you understand how inflation works, you'll see that the cost of building actually goes up, and that's where a lot of the inflation is baked into the cake. It's not about what you want as an investor. Just remember that. It's not about what you want as an investor. It's what the bank requires from you to give you more money. So you could have 2 houses for 500 grand a piece, a rent for $500 a week, you got $1,000 a week, and then you tap out your servicing. But you could have, say, 10 properties at 200 grand a piece. There we go. Angela said here, I'd like to think my bank will pay me to have a loan with them. It actually is a thing it is actually a thing where there is negative interest rates out there. It's happened throughout the world. Do some research into it. It is a very much thing. I think there was a Swedish bank that went negative 50 basis points, which is 0.5% negative. They were paying the consumer to have their loan with the bank. I think it was on a 10-year loan cycle, and that was in about 2018, 2019. So yeah, interesting times. But with building out a portfolio, would you rather have, getting back to my point beforehand, would you rather have 2 houses? Most people are like, I want to have 2 houses, want to have this, want to have that. But it's what does a bank require from you to keep giving you money? So do you want 2 properties for 500 grand a piece, or do you want 10 properties, at 200 grand a piece? So if you've got 10 properties at 200 grand a piece, you've got $2 million worth of asset with 10 different tenants in there, maybe a higher cash flow, whatever. But net position, you've got $1 million exposure to the market, you've got $2 million worth of exposure to the market. If those markets were to double, would you want to see the $1 million double from 1 million to 2 million, or do you want to see the 2 million double from 2 million to 4 million? So having a strategy and then reverse engineering, going, well, what does it take? What do I need to do in order for me to be able to make that portfolio work to get to where I want to be? So what I mean by that is that if you wanted to have 50 grand a year income, well then go, okay, that's $1,000 a week. If you want 100 grand income, well then that's 2 grand a week. At the moment, most people are going out earning 50 grand, 100 grand a year. from, let's say it's 100 grand a year, that's 2 grand a week. You have to go and sell 5-6 days a week in order to go and earn that salary, for you to do that job, to get the income, etc., etc. Building a passive income stream would be, okay, how do I make that $2,000 per week passive? What does it look like? So, just some simple numbers to be thrown around out there. That could be 20 properties that give you $100 per week cash flow. That could be 6 properties or 7, let's say 7 properties, 6 properties, 7 properties that rent for $350 a week. That would be owned outright. So how do you build out that position? What do you need to get there? What does 7 properties, let's say these numbers just like they're packets of chips, but that's what myself and my investors and we've been able to do over the last, I've been doing it for 20 years now. I bought my first property 20 years ago in 2003. It's now 2023. People thought it was impossible back then. The difference was there was no Facebook, there was no YouTube, there was no social media, there was no way of finding good properties, there was no way of finding getting the data and the information as readily as what we've got it available. But there's still properties out there, and still to this day, that are cheaper in 2023 than what they were selling for in 2010 and 2008 and 2005. So, it's finding those right assets. But looking at what do you need to get to yourself to get to passive income, depends, how much options you've got. I see people, I was actually talking to someone yesterday about buying a property. I bought something locally, it was a duplex around here, and they were 650 grand a piece. And I said to this person, hey, go buy the property. And they're like, oh yeah, I need to sell 1 or 2 of my properties that I bought 6 months ago. And I'm like, do not, right? I refuse that you even think about buying this property if you are going to sell one of those properties, because it would be detrimental to your position, because you'd be cutting off a cash flow position. Those properties are very good cash flow for that person, and it would be adding a property that would be slightly negative, but it's a lifestyle property for that person, into the mix. So you need the balance of that cash flowing asset to support that. And I drew it around for the person and said, hey, pull a bit of equity out. You've got 200 grand worth of equity over here. We can pull out that equity, and that forms part of the deposit to buy this property that you wanted to buy. So yeah, a lot of people just instantly think they sell an asset, whatever, but it's how do you generate that cash flow through it? So there's many different ways, but ultimately you need to keep the bank happy to keep lending you money. We've had people come to us where they've got 50, 60 grand worth of income, and they've been able to buy 15 properties. And people go, how do you afford to buy 15 properties at an income of less than 500 grand a year, right? And it's, okay, what's the price of those assets? What's the cash flow that those things bring in? And I was talking to someone probably about 4 months ago, one of my investors, without giving much detail into the position of this person. Their income was about 70 grand. Their rental income was about 180 grand a year, and with like 14 properties. And we're talking, I said, and the debt level's about $1.5 million. So $1.5 million is really nothing in debt compared to the amount of cash flow that's coming through the portfolio. And interest rates have gone up. So I turned around and I said, what we should do is push the rents up. And went through some rents. Rents went up by about 30 grand a year just from that discussion. Someone just texted me, right? Someone literally just texted me on phone, because I'm filming from a phone. And that person's in for a treat, because they sent me their portfolio today, and they've got about 400. Part 2, guys. I'll give it a couple of moments for you guys to hop back online. Something went wrong and the video had lost connection. Apologies for that. I'll make sure that we get straight back into it. I might give about a minute for everyone to get back on to the video that we lost. I think we had 80 odd people in the video, so hopefully you all come back pretty quickly, and then we can get back into my conversation, because I was on a bit of a roll and I was excited with what I was sharing with everyone there. Cool. Well, I'm going to start running with it. We've got back to 30 now. I'm going to get straight back into it. So yeah, as I was just saying beforehand, I was talking to this person. They are on like 70 grand income, 180 grand rent, 14 properties in their portfolio. I said, look, your interest rate's gone up, but let's put your rents up. And if the interest rates hadn't gone up, it wouldn't have given the opportunity to push those rents up. So we went through the portfolio, $50 here, $20 there, $30 here, whatever. And that person's portfolio was able to go up an extra 30 grand a year or $600 a week. And in turn, what that did is that shifted that person's rental income from 180K a year to 210. And it occurred to me that, hey, hang on a second, your income on a good job that you're doing for 70 grand a year is only, your rental income is 3 times the height of, or 3 times the price of the income that you bring in from your job. And instantly, from you just pushing up some rentals there, you've been able to put up the rents by about 50% of your income, right? So where does it come to a point where you can, retire from your portfolio? Where does it come to a point of, be able to live off and get that rental income coming through and that passive income? And I think it's important to go, okay, am I there at that position? What do I need to do? So I see people making the mistake through, whether it's people that are having conversations with us at B.Invested, or whether it be people that we're buying properties for, and they're like, no, I want a property that's positive cash flow, $100 a week. And quite often, everybody's position is unique. Everybody's position is different. And quite often what I realize is that people are too fixated on something that's in their mind of what they want, but not what they need, right? So they might be on 200 grand a year, right? Just throw it out. Some people are on 200 grand a year, some people are on 40 grand a year, right? But I'm just going, up a notch with the income. They might be on 200 grand a year. They can't save for shit, right? They can service for 20 properties, but they're wanting to buy that property that's putting $100 a week in their pocket or $50 per week in their pocket. And I'm like, hang on a second, what you need, you can buy 20 properties, right? But you don't have a deposit because your savings is no good. So what you need is equity from those properties that we're purchasing to be able to bankroll yourself into the next one. So the first deposit, pull it out, go for the second one. So if you needed 50 grand deposit to get into a 200 grand property, how long will it take you to save that 50 grand up? If you're getting $75 a week positive cash flow, right? After all expenses, council rates, water rates, real estate fees, whatever, that's $75 today. But if you put the rent up $20 next year, that goes to $95. Put up $10 a year after, goes to $105. Put up by $50, goes to $155 a week. So once you've got that asset, you can squeeze that cash flow from it. But if you don't have the asset, then you can't do shit. How long is it going to take you to get to your next property, to your next one? So if you're waiting for your property to spit out enough positive cash flow to save a deposit, if you're getting $75 a week, let's call it $4 grand a year, it's going to take you 12 or 13 years to save up from that passive income. And what's going to happen to the next property that you could buy using that passive income? It's going to go up a hell of a lot more, right? Because we know what's happening with inflation. So if you're in that position, then you'd be looking at something more so towards getting 50 grand equity from, so you can use it for your next deposit straight away. I know a lot of people will be watching going, oh, well, you're going to pay interest on that. Well, 50 grand, how long is it going to take you to save up 50 grand? It might take you 10 years to save it up at that rate. Otherwise, you'd have heaps of them. But the reality is that if you're pulling out 50 grand worth of equity at, say, 5% interest rate, that's $2.5 grand a year, $50 a week. If you can put your rent up by $50 or get the new property that you're acquiring, so you pull out your equity from your first property, it loses $50 a week, you buy the next property that gives you $50 or $100 a week, then that positive cash flow is paying out the previous one's worth of interest. And then as you have the compounding effect, you've got not just one hook in the ocean, you've got 2, 3, 4, 5, 6, 7, 8, 9, 10 hooks in the ocean. When I say the hooks, they're the property, because you've got the asset then you can go and pick up rental income, right? So if you've got 10 properties, you've got 10 sets of tenants that you can put the rent up $50, $10, $20 a week on. That's amazing, right? If you only have one tenant, well, then you're only going to get $20 a week. But if you've got 10 of those tenants, now you've got $200 a week. And as you build out that portfolio onto scale and as to onto size, then you have the opportunity to look at other things, right? So someone might get to 10 properties and they go, well, I'm shit out of luck. And I saw an email today, I just caught up on 6 weeks worth of emails, right? And I get 1,000, 1,500 emails a day. And I caught up on 6 weeks worth of emails last night. And someone said to me, oh yeah, I'm stuck, I can't pull equity, right? I think it was today, someone told me, one of our clients, and I'm like, I wanted to know the specifics down to, no, it was actually, I know who it was. Someone just texted me an hour ago, right? And I said, how much, like they've got 100, and I think they've got, and this person will know who they are when they see them. It's a bit of a shout out to them, but without giving their personal position away. They've got access to 140 grand in equity in their property, but they can only pull out 40 grand due to servicing, right? So I'd be sitting there going, well, why can't I get the extra 100 grand out? What would I need to do to get that extra 100 grand out? Because if someone was to give me 140 grand a day and I had good servicing, that would mean I've got 3 deposits there in order to buy, 3 more properties to be able to pull, to add to the position. So how do you get your equity out? It's like, well, first thing's to work out, why am I failing servicing by another $100,000? What do I need to do that? So if I've got 5 properties in my portfolio, well then maybe I can put the rent up over here by $30. Maybe I can put the rent up by $20. Maybe I can put, the person that I spoke to yesterday that emailed me their portfolio, that just sent me an email and a text just before the last video came out. I saw him on the weekend, he came over. His position, he's like, I'm stuck at servicing. I only get servicing for 650 grand. I'm like, that's good. We want to buy property for $1 million. We want to buy like another half dozen for him straight away. How do we get it up? And he's like, well, finance has said this. I looked at his portfolio, $400 a week rental increases that you can put across, 5, 6 properties in your portfolio. Now, he's not even watching this because he doesn't have Facebook and whatnot, but now that extra 20 grand income would help service for an extra, 100, 150, 200 grand, depending on the bank, depending on the calculators and all that sort of stuff. So you need to constantly be looking at your portfolio and thinking, well, what do I need to do to get to the next stage of my journey? It's a decision that I'm going to take. People make decisions every day of the week. And I was talking to someone on a map session this morning about decisions, and he said, I've set up a super fund, I've done this. He goes, I could have got screwed, didn't add up, listening to you, all adds up, these sort of things, 1, 2, 3. And I said to him, the best thing to do if it doesn't make sense is to do nothing, because if you do something, it's very hard to, go back and fix that up after you've caused a big fuck up for yourself. So, if it doesn't make financial sense, don't make that move. You need to have clarity in how is this going to open up the next gate for me. So if we're playing a game of Sonic the Hedgehog or Sega Rally Championship or whatever computer game anyone plays, I don't know any computer games nowadays, but if you want to get to the next level, you have to get through the checkpoint. You need to get through certain adventures to open up things. You need to think about, okay, what do I need to do to open up that next door, and who do I need to be to go up and level that to get to the next level, really. So I think keeping the banks happy is one that people don't even think about. Everybody's goal should be having more assets. More assets give you more options, more choices, more hooks in the ocean, more equity pools that you've got. If you've got 1 property, you've got 1 chance to pull equity. You've got 5 properties, you've got 5 options to pull equity. You've got 20 properties, you've got 20 options to pull equity from. So yeah, it's just working out where you are, what is the end goal for you, what is it that you're trying to achieve, what do you need to do in order to get there, and if you are stuck, well, what do I do to get out of this position? Most people think, okay, I've got to sell a property, I've got to sell an asset to unwind my position because I've screwed up, but it doesn't always involve that. It could just be that you push up some rents. I had someone email me in my emails of, sorry, my back's a bit sore at the moment as well. I had someone email me about some of their properties, and 2 of them are in Sydney. One's renting for $350 a week, and one's renting for $450. And I saw the email, I replied to him, and I said, "Hey, what are the rents that you're getting?" He says, "Ask me about the properties," and he told me the $350, $450. And I wrote back and I said, "I'm going to get someone from Blink to call you, because I think that the $350 should be $450 to $500 now, and the $450 should be around $600. So it was just that one little tweak that could open up $250, $300 a week. It's like 15 grand a year, right? No one's coming to save and go, "Oh, here's an extra 15 grand just for doing nothing." But it's looking at what you have got. That was an easy fix, right? Didn't have to do anything. Just send off a few emails, make a few phone calls, make it happen. But you could be sitting here going, "Okay, I've got 5 properties, I'm kind of screwed. I've got to sell one off," whatever. Well, sometimes that could be a good thing, right? I'm not telling people to sell or not to sell. Most people that sell a property will come back to me and say, hey, I'm really pissed off. I sold a property 10 years ago. And I don't give the advice to sell or what to do. You need to make sure if you are going to sell it, how is that going to help you improve your position? What steps are you going to take immediately to be able to push forward to the next 5 steps? If you're going to sell something and it's going to take you back a step, right, that's no good. If you're going to sell something and be able to move 5 steps along the chessboard, well, that could be a good position, but it just depends. Everyone's position is different. So there's my, no financial advice sort of disclaimer, because people do make silly decisions based on things that they hear on the internet. So I'd be sitting there going, okay, well, what do I have at my disposal? It doesn't come at selling a property or selling an asset and offloading the asset. It's about how do I tweak and refine that? They could come in the format of doing a renovation. The renovation that you could do, you could spend $5,000 and get an extra $50 a week. $50 a week on $5,000, $50 times 52, 2,600, 2,600 on $5,000. It's like a 50% return on investment for your investment. So what things, like people might be sitting there thinking, oh, I don't have the ability to do anything. It's like, well, I'm not telling people to go get credit cards and do renovations on them or anything like that. But if you had 10% interest rate on a credit card, or you had the ability, let's say you've got 10 grand entered your bank account today, you've got a 10 grand credit card you can pay off, or you can spend that 10 grand on fixing up your property. Your property you spend 10 grand, it might go up by 20, 30 grand. So you've got equity built into it, but your rent might go up, $50, $100 a week. So what does that unlock for you? How does it help you move forward? All those sorts of things. So do look at, how you can add some value to your properties. Is it in granny flats? Granny flats are the poorest investment I could ever think of, right? When someone says to me, I'm going to build a granny flat, I'm like, okay, your strategy isn't strong enough. I'm not trying to hang shit on people with granny flats. I think your strategy ain't strong enough. You're not thinking about elements of risk that are attached to you for doing so. You're snookering yourself, and you don't understand the value of the capacity, and you don't know how banks work, and you don't know how the asset will be impacted moving forward. So, someone says spend 200 grand for a granny flat on a property. I'm like, well, you're devaluing the asset because you're adding a granny flat there. If you spend 200 grand, are you going to get 400 grand from that? Generally, you'd have to do that thing using a lot of cash capital or equity capital into the deal. Harder to get loans and whatnot for it. And then you still got that one asset, which, you could be pricing yourself out of the market. So I'd rather spend 200 grand on buying another asset, which has the ability, you could buy a 250 grand property for 200 grand, rent for 350 a week. Now I've got an actual extra hook in the ocean to catch equity growth and cash flow from, because adding a granny flat could get you a bit of cash flow, but you overcapitalize on adding extra risk into your portfolio because you're putting too much capital in that one asset. And you don't have any potential to pull equity out from it or have growth from it, because you just got a building onto another property. So just things to consider when building out that portfolio. So I think most importantly is what I'm sort of trying to say is make sure you've got a plan, make sure you've got a strategy on where it is that you're going. You can just go, okay, well, I can add $50. A lot of people, I've seen this the last few years actually, and greed and fear have caused this to occur. Just made me think of it. I used to buy about 50 properties a month in southeast Queensland, like Gold Coast, Brisbane, Tweed Heads, those sort of locations. Those things were like 180 grand, 200, 220, 250K. They're all like 500, 600, 700 grand now. They're renting for 350 a week, 300 a week, which is great at the time. They're neutral to positive cash flow properties, fantastic. Those things have gone up. A lot of people have sold them, right? But the reality is the people that had 10 of them, and they put the rent up from $300 a week to $600 a week, they're now getting $300 a week times 10. There's $3,000 a week. There's 150 grand a year passive income, right? You sell the asset off, you don't have the ability to get that $300 a week. So many people that got excited because they made 100 grand, they sold the asset off, or they got scared and they sold it off, or they didn't look at it holistically about, okay, well, that's what it did in 5 years. What will it do in the next 10 years? What will it do in the next 15 years? What will it do in the next 20 years? What other options are there apart from selling it off? And, when you sell off an asset, if you can't service, right, what are you going to do by selling off that asset? You may or may not be able to go and rebuy that asset again today, because you might have bought it 5 years ago, but lending was at a different world and a different time and a different position. If you do sell off the property, you should be planning about that and going, okay, well, I'm going to sell it off because I want to buy more, but my servicing doesn't allow for it, but my loan is with a big four bank, etc., etc. What other options are there? Could you, sell the property off, get a portable loan, security swap it? People out there, they've got a 500 grand property loan. The property's worth $1 million. They think they sell it off for $1 million. They pay out their 500 grand loan, then they've got 500 grand in their pocket to go buy some asset. When in reality, they've got that 500 grand loan that they've got. They could they could buy 3 properties at 200 grand, put down a 10% deposit and have the 80% loan at 500 grand, and they could buy more properties and attach that loan as a security swap. So people don't realize that there's certain steps that you can make to refine your portfolio and to push it and accelerate it to the next level. As I said, I'm not here to give you guys financial advice. Last week I had Peter from Zinger Finance, and I think that you all got a good knowledge base from him to see, sort of the team and the caliber of people that I've got around me. Peter is from my finance team, and he doesn't give financial advice. He's just there as a mortgage broker to help people build finance strategies to get their goals and get their dreams. But it's important to understand, well, what options are there? Like, where do I sit in my portfolio? What can I do to to push myself forward? Is it a roadblock or is it a building block? Most people look at the roadblock and go, there's a brick wall there, I can't do anything with it. It's like, well, we can pull those bricks apart, stack them up in a different format, and build ourselves a house and have shelter around it. So, what do you have? The question I think everyone should be thinking is, if you're not at the position where you want to be at, what do you have at your disposal? What options do you have? And what things can we do to move forward? I've got just a few sort of wins that I've seen people do recently of people that have been able to get to the next level. I held an event 2 weeks ago. It was in Sydney. I don't do seminars, I do Facebook Lives and webinars and stuff like that. I do have a webinar tomorrow night with Wayne Murray from my investor relations team. So make sure that you register for the webinar. If you don't know how to register for the webinar, maybe one of my team could put a link to the webinar registration in the description here, or send us a message, an email, or whatever. You can get access to that. It will be on tomorrow. I think it's at 7 o'clock, same sort of time as today. I think everyone should be there. But yeah, nevertheless, I don't normally do seminars. I did do a seminar, first seminar I've done for 5 years, and it's probably 5 years before that I did another seminar. And I had some people turn up, and I got one investor who, over the course of the last 10 years, literally came to me 10 years ago, bought his kid a property. He's probably watching this, his kid's probably watching it as well. Just bought his kid his first property, which is really cool. Makes me feel old, but it's really cool to see that. And this guy has roughed it out, pushed himself into a nice portfolio where he's got his 10, 15, I think it's about 15 properties he's got in his portfolio. It's definitely more than 10. And I'm at a point where he wants to retire from his job. I just used his portfolio. I thought, do I have to sell off? One of his properties is in Vaucluse and stuff like that I bought. I don't just buy shit boxes in the middle of regional towns. I buy collectively different assets to get for different parts of the journey. And we've spent about 6 months working on his finance strategy to get him attractive to the bank, to get him to where he wants to be. We just bought a block of units that were only about 10 years old. I'm not going to put the exact sort of real numbers in there, exact numbers. The real numbers are, it's 178 grand per unit. There's about 20 of them. I'm going to say about, because it could be more, could be less. It's 178 grand, about 20 of them that he's buying. The rent on them are about $400 a week. He's going to own the whole complex, but he's using equity from his portfolio. Those properties are now going to be able to support him to get this one property, which after all expenses, all finance, everything will be positive about $150,000 to $180,000 a year. So that's, it's not just linear. These people don't wake up. It's like, you want to be ripped and built. You don't just wake up and go, oh wow, fuck, got 6 packs, got all this. You need to. Thanks, Andrew, for posting the webinar link. There's a webinar link in the description. Andrew's just posted it there. You don't just wake up and go, fuck, I'm jacked and I've got the body that I want to have from waking up. It takes commitment, exercise, all those sorts of things. So, what good practices and what good habits are you putting into your own personal financial position to get yourself to where you want to be. This guy's been doing it for 10 years and he's at a point where he's going to get retired shortly, and I'm really excited to see him do that because I know how important it is for him and his family. Another guy who wasn't up on stage that was talking at that event, but I threw a few people to his direction. He started with me 3 years ago, and he said he wanted to get 300 grand a year passive income. I said, you need to have 20 properties to get there. And he goes, how long will it take me to get there? And I said, I think that it'll take you 2 years to get there. He goes, get me there in a year. And I was like, look, I can try. I can try to get there, but no promises. That's all we can do. This guy got 28 properties in his first year. I think he's at about 38 properties now, 3 years later. Positive cash flow there was 150 grand a year. Obviously interest rates have gone up, but his rents have gone up, and he's sitting really pretty. So, that guy always says to me, I should have come to you earlier, should have done things quicker. I was like, the right timing, the right position, the right, you need to be on the right day. So, I think it's important, these success stories that are out there don't just happen overnight. It's a gradual progression of, certain steps that people take and habit forming that people have. And, I think it's important to look at your position, be obsessed with it and look at, okay, where am I today? If I'm not where I want to be, what do I need to do in order to get there? Will it happen overnight? It can happen a lot quicker than what you think it would happen. And as I said, that guy with like 38 properties got there in a period of 3 years. People think, I can't get to 10 in 10 years would be something, out of the realm of possibility. But, see, most people get to 10 properties. I think my average time frame to get to 10 properties is about 2.8 years, like about just shy of 3 years for most people to get to 10 properties. So that's just on an average. Throughout all the data of all the investors that have been working with in the last 15 years of doing B.Invested. So, looking at it, looking at what things you can tweak in order to push your position forward. Could you get cheaper expenses? Could you, when was the last time you looked at interest rates? Could you go and refinance to a cheap interest rate? Is your discount enough? Could you go back to your existing bank and ask them to change your discount on your interest rate so you get a lower interest rate by 1%? All these little things that you can tweak with your portfolio. Like most people just go, oh, I've got a property. Now, I see people that have bought properties 4 or 5 years ago and they haven't really tweaked their position. They've kept their property with their local property manager. They don't have Birchie looking after their rents and going, hey, let's push up those rents and whatnot. I'm like, why is your rent so low? Oh, because, they're a good tenant and all this. I'm like, who gives a shit? You're a good landlord, right? You'll find a tenant. Be proactive on that. So what can you do? I'm not talking about going, okay, everything else in your area is renting for $400 a week. I put your rent up $500 a week because that's being a dick. And it's not going to happen. You're going to lose your tenant. You're going to be sitting there. You're going to have all these vacancies. But if you've had a tenant in there for a while, you haven't put your rent up in the last 6 months or 12 months, what things can you, when was the last time you looked at what's renting in your neighborhood, right? Or in the same complex or the same street or same comparable sort of properties to yours? And why is yours not getting that? What do you need to do to it? Is the other one's better? Most of the time, people don't need to do anything to their property. They just need to put their rent up. And that's a very easy, quick fix win. If you've got 10 properties, you've got 10 times that you can put that rent up. If you've got one property, you've only got one time you can do that. If you've got 50 properties, you've got 50 times you can do that. So get scaling. One property ain't going to get you retired. 2 properties ain't going to get you retired. They might, depending on your level of retirement, but it will generally take 5, 10, 15, 20, 30 properties to get to the level of where you want to be to retire. And I say those numbers not just being flippant or making them up and going, oh, you just need 20 properties, whatever. There's a lot of thought and reverse engineering into working that strategy, which is what you need to get you to where you want to be. And everybody's position is different because they're starting from different positions, end goal are different positions, timeframes are being able to change and all that sort of stuff. So as for retirement, as I said, I've got one person there who's been doing it for 10 years. Their position is really beautiful. Like that person came to me 10 years ago, first property as an investment, built it up from scratch. Going to retire in this next few months. Had a very good life, working all that. Other people being able to do it in a quick time. We've got someone that got got a young lady, which is about 30, I'd say. She'd probably know who I'm talking about if she's watching this. She is about 30 years old. I've got her over 30 properties in the last 2 years. Right? It was literally September 2 years ago that I spoke to her for the first time, and I got her over 30 properties in 2 years. So, everybody's position is different. Some people have got 10 properties and they get 50 grand passive income coming from it pretty quickly. Some people, get 30 properties and they've got shit tons of equity that are coming through, and, they may not pull the equity out. Some people might have, 20 properties and they might be neutral cash flow. Everybody's position is different, but what can you do to keep tweaking your positions? And none of the people I've seen with large double-digit property portfolios have just woken up and it's just been a breeze of going, oh, okay, this is how it happened. It's all come from being committed, being focused, trying to continuously tweak and refine their property investing strategy. And the wealth that I think that everyone is focusing on is intergenerational wealth. It's not even just the wealth for today. It's being able to pre-live them in other sort of realms of existence. So, looking at that, if you've got 10 properties and you can push that rent up $100, there's your $1,000 a week. If you've got 10 properties and you pay out those mortgages and they're renting for $400 a week, well then there's $4 grand a week or 200 grand a year. So how quickly there's no one size fits all. Everybody's position is different. Everybody's journey is different. It's just what works best for yourself. So, I've seen people do it in 2 years. I've seen people do it in 10 years, but they're just a few little things there. I'm just going to go through your questions now, so do keep your questions coming through. Do you think eventually a 1 million house will be $4 million in 20 years? I know it sounds crazy now, but it's likely. Good question there. Zach, I actually did a video on this going back about 2 years ago, maybe 18 months ago, about houses in Western Sydney and how they could go up from $600,000 to $6 million. And it's all because of control of our currency and the money supply that's out there and the cost of the level of inflation that's out there. So, and the playing around with monetary policy. So, could I see a property, depending on what it is, where it is? I sold some properties last year, not because I wanted to, it's because I bought my dream house and I wanted to buy it sort of cash. It was a $4 million house, and I just went, okay, how am I going to afford it? And most people would go, I actually thought about it recently. And I thought, if someone wanted to buy a $4 million house, if they had to save up to buy that thing without interest repayments or anything like that, it would take 80 years of saving 50 grand a year to buy a $4 million house. It's fucking absurd, right? Because how many people are going to be able to afford that? But how I was able to do that is I sold off some properties, and I sold off one property I bought in Noosa for in 2012, so it was literally 10 years that I held it for. I bought it for $320, $330, $340. I only owed about $200 on it. I sold it for 1.2, pulled out $1 million. There's $1 million towards the portfolio, towards that property. I sold about 5 properties on the Gold Coast that netted me $1.5 million. But if I didn't take those decisions the 10 years prior, the 15 years prior, the 8 years prior, I wouldn't have been able to do that. If I wasn't able to, if I didn't, at the time of selling those properties, the day I was like, hey, I need to buy that property. That's what I want to have, that's what I need to have. I didn't know which property I was going to execute in order to make that happen. But I had hundreds of options with hundreds of properties, and I'd be like, okay, that's the least, annoyance to my portfolio. Let's make it happen. So, yeah, I would never have picked those properties that I sold would have gone up like they did. There could have been other properties that I would have been like, wow, I expected better from you. Why did you perform not as good as those ones? But property isn't linear. Nothing in life is linear. There's things that occur for these things to happen. And it's just a matter of me constantly being on top of the ball game to go, okay, that's the opportunity there. And I really think with the properties that I sold, when I look back in 10 years' time, that they'll probably be worth what I sold them for. And I actually look back at some of the properties. I sold some properties off in 2017. I was buying some commercial properties and some bigger properties at the time, blocks of units and some big land bank holdings. I bought like 200,000 square metres of land in northwest Sydney, and I needed to let go of a few properties. And the properties that I sold back then, I think I sold about 8 or 9 properties, and there's only 1 or 2 which are, I'm like, I wish I didn't sell those ones. The balance of them, I was like, shit, those things haven't even gone back to where they were at their heights of 2017. And 2017 wasn't the greatest time in the world either. So just something to bear in mind there. Luke says here, evening Birchie, the girl with 30 properties, what level of personal income and expenses did she have? Was she rent vesting? She is rent vesting. I can't really go into her specifics of her numbers. There's a bit of privacy there on that front. But it wasn't like stupid. Like, it's in the middle there. It's not, she's on 6 figures and ain't on, 80 grand a year, and it ain't on, 400, 500 grand a year. It's, find a space somewhere in the middle around there, and that's sort of where we're looking at. But still, like, people would think you can't do it with that. It says here, Nathan has access, usually posts a link though. I'll post the link on the Birch feed. So if you want to join the webinar tomorrow, which will be Wednesday the 4th of October, I think it's the 4th tomorrow, it will be on tomorrow at 7 o'clock. You need to register. These webinars don't go out there in YouTube world and Facebook world. They're private sort of webinars that get held. They take about 2 hours. Make sure you register. I have some really good content there for you guys, sharing about similar sort of stuff. I think it'll be very different to what we discussed today, but just on that. The webinar from 2 weeks ago, the seminar I did, it might be on YouTube, I just don't know. If interest rates go down, wouldn't rents go down because more investors come in? No, not necessarily. It just means that rents don't go up the same sort of height or the same sort of rate. Paul says here, Birchie, let me know when you get that property sorted. Got Peter working on the finance. Awesome. I'll be back in touch shortly with that property. Love it. If you haven't got that asset, you can't do shit. It's true, right? It's true. The way I see it, if someone has assets, they've got more options. That's all it is. If you have one option, which is your job, well, then you've only got one option for making income, and you're at mercy of that. If you've got a business, well, then you've only got that business. If you've got 5 businesses, and you've got 5 options there to work with. If you have 5 properties and 5 businesses, well, you've got 10 options there. If you've got 20 properties and 1 job, now you've got 21 things that you can do to create cash flow and capital from. So you need to look at your position and just be about collecting assets. If you can collect the assets, it's the aim of the game. That's what Monopoly is all about. So Charlie says, keep up the work. Thanks, Charlie. Hope you're doing well. Matt, you said you're on a roll. And yeah, I'm back. So what else we got here? I'm going to wrap this up very shortly, so keep your questions coming through if you have them. What are we here? Do you talk about asset protection, trust, etc. in the past or coming up? I do talk about it regularly. A lot of the times when I've talked about trust and whatnot, it's either been with Ridwan Hannon from One Path Accountants or Stephen Sidorowski from Zenith Legal. I just see that as a bit of a byproduct. If you do want to have a chat with someone about trust, asset protection, all that sort of stuff, like most people that I see with like 10, 15, 20, 30 properties in their portfolio, they don't have trusts, they don't have, different types of structures like that. Most of the time they're built under their personal name, but that's without giving any advice on that, because I can't give you those sort of, sorry, I've just seen lots of messages coming through from the top of the screen here. It depends on your situation. Everybody's position is different. So if you do want to find out more about trusts and asset protection and whatnot, reach out to my team, 1300 367 925, and my team will put you in contact with the right people to discuss it and just have a conversation about it. So that's probably the best place to start. Josh says here, stuck in growing the portfolio. what's this say here? Stuck in growing the portfolio. How do we navigate borrowing capacity issues? Borrowing capacity is probably the biggest one that people get stuck on. I think it's important to find out why are we stuck with borrowing capacity and what can we do. That'd probably take an hour for me to answer on that front, but do have a chat to my team if you want to specifics over how to overcome that. For example, I'm just going to use a couple of examples here, and that was probably more of a question for last week's webinar. So if you want to find more about that, watch last week's webinar. Me and Peter Renouf from Zinger Finance were talking about different things there. But for example, most people think, oh, you've got to sell off a property, you're screwed, you can't do anything, whatever. Sometimes it might be that you sell off a property and you could do a security swap, and you might have a 500 grand loan, but you could attach 3 new purchases. So you've got 3 rents coming through instead of 1. And with an extra cash flow, you might be getting $1,200 a week instead of $500 a week. You're now getting $700 a week extra rent. That's an extra 35 grand a year extra rent that you're getting. That might help you service to get to the next level of your journey. It might be that you've got some equity there and you need to get an extra $300 a week worth of income, which you could either go to your boss and try and ask for a higher income, but your boss might sit there and say, well, no, or whatever the case might be. You might have 100 grand. You might be able to buy a property cash outright with no debt attached to it for 100 grand, and with that extra $300-400 a week rental coming through from that property would help you boost your income up, which would help you service more. And that's probably the most common way that I help people get over the servicing there. Beautiful. Laura says, settling on one this month, ready for the next one. Let me know when you're ready. I can get those deals happening for you, Laura. I'll be back in touch shortly on that front. Jane says, need to get back in the game. We need to talk. Almost have all my ducks in order. Awesome, Jane. Let's catch up whenever you're ready. Always here to help you kick ass with your goals. Tier 2 lenders, there is tier 2 lenders, but sometimes people expire their position with those guys, and what do we got here? Someone just texted me some cool news that they got their own personal win outside of property in their own business, which is cool. That person's probably watching this as well. If not, they'll probably be watching it later. So congratulations on your business move that you did. The sooner the monetary crash happens, the sooner the hyperinflation comes, exactly as the aftermath of the next level of stimulus. This is what people fail to see. I think the next time we have an inflationary cycle, we might not be able to control it next time around. You are 100% right, Sam. You have been watching this a lot and been talking about, listening to what I've been talking about. It's very, very exciting. When we see that next crash, right, I don't think anyone's going to be prepared for it, right? Some people will be, but they'll only be like the small 1% of people out there. The opportunity that comes from that, most people are going to get wiped out. It's going to be a hyperinflationary depression. They won't understand how the cost of everything has gone up so high. But your debt becomes relevant with inflation. The more things get inflated away, the easier it is to repay that debt. If you have rental income streams, those rents will get inflated, your assets will get inflated. That's the whole aim of the game. You could have 50 years worth of growth in a period of 2 to 3 years. Terry says, looking forward to catching up in a month or two. Look forward to helping you, Terry, however I can, and catching up. So on that note, folks, I'm going to leave it as that. I am so hot. This is a brand new t-shirt I put on, and it is soaked. So thanks a lot for watching. Do remember to check into tomorrow night's webinar. If you haven't registered, join up to birchfeed.com, and I will post a link in there later on tonight, and we'll go from there. So thanks a lot for watching. Thanks for having me on your Tuesday night, Tuesday afternoon if you're over in the West, or whenever it is that you're listening or watching this. Thanks for your time. We'll catch up soon. Keep being awesome. Keep kicking ass with your goals. Good time to be alive.